Couple quick questions before we get into our topic today. We're going to be talking about the Elliott wave and how it is the roadmap of the markets. How many people out there currently use the Elliott wave in their trading now? Be very interested to know. Okay, how many people have heard of the Elliott wave but are a little bit confused by it, kind of intrigued by it, but don't use it? Okay, all right, we got pretty much a split type of audience here, which is great because what I'm going to show you today is a very high probability way in which we use the Elliott wave, and I think you're going to enjoy that. And I think after the presentation, you're going to want to incorporate this into your trading plan. So let's go ahead and get started. First thing I do need to talk about, of course, is the risks involved in trading. But you know, without those risks, I always say there's never any opportunity. So the two really go hand in hand. But realize, of course, that there are risks, and of course, you need to use risk control when you do trading. I want to invite everybody to our website at traderscoach.com. Renee did a nice job introducing me today, and thank you for that, Renee. And we really want people to come to our website. We got a lot of free stuff there that you may be interested in, so check us out. I've also written 4 books on the markets. The first one is called A Trader's Money Management System. This was one I did on risk control, and this was published by Wiley. And regardless of whether you trade stocks, futures, options, bonds, Forex, there's concepts in this book where we really focused on simplifying risk control. So you may want to check that out. The Art of Trading, my second book, the Art stands for Applied Reality Trading. That is basically the cornerstone or Bible of our trading approach. And then the Survival Guide for Traders really talks about how to run your trading like a professional hedge fund. We have business plans in there, the whole 9 yards. And then my final book, or most recent book, I should say, is the Elliott Wave Technique Simplified. And this is what we're going to go over today, some of the concepts in this book. We also have a great home study course, online home study course on the Elliott Wave if you want to learn more about that as well. The other thing I like to do, and I'm going to put up a sheet here in just a minute, a link in the chat area. And this is basically for our free Elliott Wave cheat sheet. And basically this is an easy to use 6-page PDF file. And we put in there the clear definitions and the statistics on Elliott Wave, illustrations on what the patterns look like, etc. on a chart, Fibonacci information. So you definitely want to check that out. Absolutely free. Just click on the link and it will take you to a place you can download that. Before we get into Elliott Wave patterns, however, I think it's a good idea to talk a little bit about how it came all about and who is responsible for it. And we have to start with really the first person involved, Ralph Nelson Elliott. And he was born in 1871. So we're going way back here. He was originally an accountant. He almost died in 1929. And while he was recuperating and not working, he actually turned to the financial markets and started analyzing patterns. He primarily studied stock market and Dow theory in 1932. And through observational analysis, he developed the wave principle in the year of 1938. Now, what do you think I mean by observational analysis? Well, the best example I can think of really to explain that is if you think of astronomers looking at black holes, for example. They look at these things in the sky. They understand when matter gets close to the actual black hole, it can get sucked into the black hole and disappears. That's an observation. They have no idea how black holes work. They don't know really at this point where the matter really goes. But they observe that when matter gets close to it, it gets sucked in and it's gone. Same thing with what Ralph Nelson Elliott noticed about patterns in the market. He didn't fully understand at that point exactly why these patterns form, except, we put it under the term of mass psychology. But he noticed that these reoccurring patterns occurred in markets, both in uptrends, downtrends, and corrections. And then he finally published really a nice book called The Nature's Law, published in 1946, which really went into great detail on his wave theory. And he died in 1948. So this was a time when folks looked at markets back on paper charts. They didn't have the advantage of computers like we have today. And so he actually reviewed many, many markets tediously by hand. And so you got to give him a lot of credit for coming up with that type of situation way back then, when of course we do everything by computers today. Next question you may have is, okay, that sounds interesting, Ben, but why use the Elliott wave? Well, we use it to forecast price movement for profit. We look at it for price target zones. It does encompass math psychology and puts it into a form of technical analysis. So when we talk about the Elliott wave, we're talking about technical analysis, not fundamental analysis. It is a technical analysis tool. It also identifies what market cycle we are in, and we'll take a look at that in a minute. And by noticing where our price target zones can be in terms of exact zones and of price of the market you're looking at, you can then also calculate your reward to risk expectations. So when you take all these things into account, we really like to call the Elliott wave the roadmap of the markets. Now, the Elliott wave principle, as I said, is a form of technical analysis, and whether you're an investor or an active trader or a day trader, it can be used to forecast trends in the financial markets and other collective activities. What do I mean by that? Well, what it means that if you're a day trader, you're going to be looking at short intraday time frames. And there are waves or Elliott wave patterns on those short-term time frames. There are also Elliott wave patterns on longer-term time frames as well. So you have something called minute time frames, and you have the longer-term major time frames. And we're going to go into that in a little more detail in just a bit. But the wave principle states that collective investor psychology, known as that crowd psychology, moves from optimism to pessimism and back again, and it can do it quite quickly. These swings create patterns as evidenced in price movement of market at every degree of a trend. Elliott's model says that market prices alternate between 5 waves and 3 waves at all degrees of a trend. So let's take a look at an actual stock here. And this is going to be the Apple stock. And you're going to see a whole bunch of numbers and a whole bunch of lines on this stock. And I want to walk you through this for just a moment. I want to focus first on the big numbers, the 1 here, the 2 here, the 3 here, the 4 here, and the 5. So what Elliott basically said is there's 5 waves in a trend. And when you get to wave 5, and in this case, this was an uptrend, so at the end of wave 5, then you will have the trend end, okay, and the market will reverse. And that's exactly what happened on this actual Apple stock. Now, you'll also notice a lot of little numbers inside the big numbers. And this is kind of an interesting concept. It's called fractal symmetry. And another thing that was noticed is that there are waves also within waves. And notice that waves 1, 3, and 5 all move in the direction of the trend. These are what we call impulsive waves. And when you have impulsive waves, which are the major waves in the direction of a trend, you also have 5 waves inside those impulsive waves. And that's what we've drawn on this chart. So you have a little 1 down here, 2, 3, 4, and 5. Then you have another set of 1, 2, 3, 4, and 5 here as well. And then of course, in this one, you have 1, 2, 3, 4, 5 as well. So waves 1, 3, and 5 all have 5 waves inside them, and that's called fractal symmetry. Now, the best way to kind of think about this is if you looked at a snowflake, it will look like a snowflake. But you put that snowflake under a microscope, and you'll start to see the underlying structure of that snowflake. And it'll be represented kind of in a crystalline shape. And this is very similar to seeing the waves inside the waves. So usually what we need to do, not always, but usually, in order to see these waves clearer inside the impulsive waves, we sometimes have to put the daily chart or whatever chart we're looking at under a microscope, which really means we have to go to a lower time frame in order to see the structure, okay, inside some of the waves. In this case, in this Apple stock, this happened to be a daily chart, and the underlying structure was even clearer on the daily chart. So once again, there's 5 waves in the impulsive waves. So let me ask you a question. Based on this particular diagram, what wave numbers represent the impulsive waves? What wave numbers represent the impulsive waves? What wave numbers represent the impulsive waves? 1, 3, and 5, right? Okay, so again, 1, 3, and 5, all moving in the direction of the trend. Okay, so you have actually 3 impulsive waves in a trend, 1, 3, and 5. All right, now let's talk a little bit about the corrective waves. And that's going to be waves 2 and waves 4. Okay, so we've had 1 up, and we have a 2 down, we have a 3 up, and a 4 down, and then we finish the trend with a 5. So notice that waves 2 and 4 are corrective waves, but the corrective waves, as you can see on our little diagram here, are usually an ABC or zigzag correction. They can be a more complicated correction at times, and we'll talk about that in a minute. But for the simplicity here and what happened actually on this Apple stock is we saw an ABC correction, and we've labeled those ABC, ABC here. Okay, and here's C down here. So again, if we generalize here, the impulsive waves are made up of 5 waves. The corrective waves are made up of an ABC 3-wave pattern. So those are the waves inside a wave. So in a situation like this, all right, when we get to the top of wave 5, then again, the market reverses. Now you can also have a downtrend, and the same 5 waves will be present in a downtrend as well. Now notice here, out of waves 1, 3, and 5, the impulsive waves, wave 3 is usually, and always actually, the strongest of the impulsive waves. It will have the highest volume and the highest amount of momentum occurring in that volume. Okay? All right, so that kind of gives you a good overview of the Elliott wave in terms of its structure. Now, what's interesting is what Elliott wave did back in his time is he created rules, and we've discussed some of those already. And what we do is we call those rules the classic Elliott wave theory. But there's also the modern Elliott wave theory. And the modern Elliott wave theory, thanks to computers, really has come about in the addition of being able to measure momentum in a volume very, very accurately. So let's take a look at that in a moment. But first, let's take a look at the classic again. So when we take a look at the classic here, I just want to go over the waves one more time. Here's wave 1 on this example, and this happens to be a very long-term look at the market. Here's a monthly chart, and notice that we have a red 1 here and a red 2 here, and the red 1 has these 5 waves in it with an ABC correction. So we already covered that, so you kind of understand that, I would think. But if we go out to a yearly chart over here, notice we're going to bring over or transpose the 1 and 2 in red from the monthly chart and show you how it can make up the underlying structure of a longer time frame or yearly chart. And of course, that's showing you its waves 1 and 2, but then we had 3 and 4 and 5 on this particular chart on the yearly chart. Now let's go over to a 5-year chart, and you'll see that this 1 and 2 up here on the yearly chart, we transpose to down here, and you can see how the waves are inside the waves even on a longer term chart. So this is a great example of fractal symmetry that is present in the Elliott wave. So when you do multiple time frame analysis on a market, you should be able to count the waves inside the waves. If you can't, then there is something wrong with your Elliott wave count. So that's one way in which we try to look at markets where we have that fractal symmetry in sync. And if we don't have it in sync, then we move on because something's wrong with the count. And usually that's because it's in a complex correction. Now, again, this is just another chart example of 1, 3, and 5, 2, and 4. All right, now, here's something that we haven't covered yet on the corrections. Here, if we take a look at the ABC correction here, what we're doing is we're taking a look at these corrections that occurred here on this chart, which we briefly have looked at already. And we're showing you that the A wave and B wave and C wave, okay, are not adverse to having waves with inside waves. So A and C are what we call the impulsive waves in a correction, and they are made up of 5 waves. And the reason this is important is because when you start trading corrections, it's nice to know that these underlying patterns are there, because that also helps us to determine the best time to take trades on counter trend markets. And here's just another example of a bullish and bearish scenario. All right, now, sometimes you'll see patterns that represent things in technical analysis like flags and pennants. How many people have heard of flags and pennants? Flags and pennants. Of course, right? That's pretty basic technical analysis, isn't it? Well, the interesting thing is when you talk about the Elliott wave, what you're talking about is having flags and pennants form in corrections. They don't form in the middle of an impulsive wave. You'll see them form in corrections. And so when you see a pennant forming in a correction, then you know whichever way it breaks, that means it's breaking out into the next impulsive wave. So that's a very, very good clue for you to get in early on the next major wave or swing in the market. All right, and then sometimes we just see channels or flags that form in these corrections as well. Same thing, when they break out of these particular patterns, we need to take note of that. All right, now, one of the major criticisms of the Elliott wave is that many feel it is subjective. In other words, hey, it's easy to look at an Elliott wave after the fact, but as it's unfolding, it seems to be confusing. And so what we want to do here during this presentation today is show you some ways in which you can take the subjectivity out of wave counting. And so we bring in the modern approach in order to help us do this. And it's really a form of connecting the dots. And by combining classical and modern approach, you're really increasing your odds of success in determining the wave count. And what I developed is an approach that combines several key studies that I have found over my over 20 years of trading and using the Elliott wave that has added a lot of probability to a wave count. And so I want to share those with you today. And these components really consist of combining some classical with some modern. So let's take a look. We got classical approach. This is basically some of the things that we already looked at. We looked at price patterns, the fact that there are 5 waves in a trend. Corrective waves are usually an ABC pattern, but can also consist of complex corrections. How do you know it's in a complex correction? Usually when we see a pennant or a channel form in one of those types of corrections. So all these types of things lend themselves to what Elliott observed in the classical approach. We also add in something called Fibonacci, and Fibonacci levels are great to determine the high probability target zones for a wave 4 retracement and a wave 5 target end of trend zone. So those are very important. You can use time extensions as well. We also use some special histogram indicators to confirm Elliott wave count. You can use volume, you can use momentum indicators, fractals in the market, all these things that can help you identify certain patterns that add to the higher probability that your wave count is accurate. What I did is created what they call a probability matrix, where we assign a percentage to some of these categories in order to only use or only trade in the direction of the highest probability wave counts. So that will help you an awful lot as well. And of course, you have to use risk control on each and every trade. All right, so does the Elliott wave theory work? All right, we're going to take a look again. I want you, as we look at some charts here, take into consideration combining the modern and classical approach. So let's take a look and see some of the indicators that we use when I actually form a probability matrix. We're going to look at clear structure. In other words, can we see the waves clear enough, or do we have to scratch our head a little too much to try to force them into what we want to see, so to speak? If you're going to do that, it's best to move on to another market. We're going to take a look at something called the price oscillator histogram, and we've converted that by adding some bells and whistles to it to call it the OWL indicator. We also are going to look at volume. You can look at volume, Fibonacci levels, like I had mentioned before. We're going to look at relative strength index, and again, we're going to use something called the PTF software to do that we developed here. And then we're going to look at sometimes multiple time frame alignment, meaning is the wave count in sync with other time frames. So when you start to do this on a consistent basis, this is how you can actually take the subjectivity out of a particular wave count. Now on this market here, what we want to point out is we have something down here called the OWL, and this is measuring momentum. And then below that, we have something called the PTF, which is also something that we use in our Elliott wave counting. These triangles and so forth, this is part of the ART trading system. This is not crucial for Elliott wave counting. We use that, however, for entries, exits, and risk control. So notice here, I want you to go to the momentum indicator, the OWL, which is also a good measure. Usually when the momentum is the highest, the volume is highest too, but not always, but usually. So in this case here, we rely on momentum, and that's all we really need in this particular case to count a wave 3 when you have the price structure as prominent as it was here. So classical, we're going to look at price structure. Look at how fast this move went up. All right, notice how high at this particular point here the OWL histogram measuring momentum was. Then notice we had a break. We had a turnaround, a pivot point, a fractal in the market, and it started moving down. And notice what happened to the OWL. It went negative. All right, the OWL must go negative on a bearish wave 4. If it doesn't go negative, then you're still technically inside a minor pullback on a wave 3. But in this case, you can clearly see it going negative. All right, notice here, again, if we pop up to the classical approach, we can see a clear A down, B up, and C down. There's your ABC with a red colored OWL. Next thing we did is we drew a Fibonacci retracement area in here to see if the wave 4 down here, the bottom of C wave, actually ended up in the high probability wave 4 target zone, and it sure did. 70% of the time, wave 4 is in between 38.2 and 61.8. All right, so we hit it there. Then the next thing you want to do is after it hits that target zone is then you want to see where wave 5 is going to be going. And we do that by looking at a wave 5 target zone. So what we do on this is we wait for the OWL to once again go green, like it did in this area here. And then what we do is use our fib extensions and anchor it on the same place we did our fib retracements, but then anchor it at the bottom of 4, and that gives you your fib target zone for wave 5. And again, 70% probability that prices hit that target zone. 15% are a little shallow. All right, and that's exactly what happened. Then the market moved up, hit the target zone, and then the owl went negative again, or red. And then once that goes red, we can start looking at trades, especially when it starts taking out key levels of support that formed on the way up during the 5th wave. Now notice here, during waves 3, 4, and 5, all right, we didn't even see a red colored PTF. All right, that's kind of normal. You don't usually see a red PTF forming until you have a change in trend. So when you look at the Elliott wave, not only in terms of structure, how the price looks, you know, we can easily see this, but when you start combining it with the modern approach, okay, you start aligning things a lot better for a higher probability count. Now, if you showed up late in this trade, let's say you missed wave 3, you missed a corrective wave trade, and you missed wave 5, well, don't give up, because you know after wave 5, you're going to have a change in trend. So you can take the trade to the other side. The other important thing, and I'm sure many of you observed this already, is notice that between the owl indicators wave 3, labeled here, and wave 5, we have a red line drawn showing bearish divergence. So as prices make higher highs, the owl does not. And that's a rule in the modern approach that basically says you always have, in an uptrend, bearish divergence between wave 5 and 3. The other rule for this is you always have a bearish wave 4 owl for it to confirm a wave 4. So you must have a red wave 4 owl. Okay, so that's kind of a neat one. Let's take a look at some others. Here's an example of a downtrend in place. And notice here that we've got labeled, this is your wave 2. So we had a 1, 2, 3, 4, and now we're heading down into the target zone of 5. Notice here we have bearish divergence between 3 and 5. We also had a bullish owl here on this way down. Okay, so there you have it. So this would be our wave 5 target zone. So whether it's bullish or bearish trends, doesn't matter. Here's another stock. This happens to be PEIX on a daily time frame, where we had a 1 here, 2 here, 3 here, 4 here, and 5 target zone. All right, looks similar to Apple. But in this case here, notice this wave 3 had a gap in it. Okay, sometimes you get a mid-wave gap like this, but not all threes will be exactly the same. All right, but again, this is where the owl can help you. Notice it was the highest here, and then you had no red PTF after wave 3 started, and then you had an ABC wave 4 here, and then a wave 5 up here, and bearish divergence. So we know when we reach this target zone, we start looking to scale out, and we basically move our stops up until we're stopped out. Here's a downtrend where, again, we had an entry here, and we had a wave 3 down here, wave 4 up here, wave 5 finishing here. Okay, not quite over yet. Probably going to head down a little bit more because the owl PTF is still red. All right, so that's kind of how you can use the modern approach, which really helps quite a bit in terms of adding to the probability of your wave count and taking out the subjectivity of the Elliott wave. Now here's one, and this was kind of an interesting one we did back in the year 2000, and I was managing money at that particular point, and notice how steep the wave 3 went up at this point. And when we saw things roll over, which was later classified really as the dot-com bubble, so to speak. We then immediately drew our fib retracements in at that time, and we were looking for a target zone basically in this area here during this elliptical. That was between 38.2 and 61.8. So this was your high probability target zone for wave 4. But things, you know, after it took out this support here, then the probability increased that it would end in this elliptical here. But what's interesting here is that right after we had this situation where it broke, okay, and went below the support area, we were basically advising people that at that particular point, the Dow could drop into around 7,500. Now, at that particular point, people, and this was back in the 1990s, okay, just got off a huge bull run, and their mindset had not changed yet fully to the fact that a minor pullback in the market was nothing more than an opportunity to buy, because that's what they had been doing for basically the last 20 years. But we came out with a forecast that said we think the markets are going into the 7,000s. And everybody thought we were nuts. And the reason we said that is because of the Elliott wave. And sure enough, the market did get down to this elliptical. Unfortunately, we had 9/11 come into play here, but it got down into that area and then it recovered like we thought it would as well. So this was a fairly clear Elliott wave count that occurred back even in the 2000s during the dot-com bubble and after. Notice too how steep this wave 3 is. Usually wave 3s are pretty easy to identify. And once you can identify a wave 3, it's pretty easy for you to know what's going to happen next. All right, so there you have it. The other thing too that's interesting is in the impulsive waves, like a wave 3 and the coming of wave 5, you tend to, in a bullish trend, the market will tend to ignore bad news and focus or accentuate the good news. In a downtrend, the impulsive waves in a downtrend will accentuate the bad news and disregard the good news. And you know, what's interesting is we're in a wave 3, towards the end of a wave 3 in the current market that we're in, the Dow. But notice with all this mess with North Korea, the Las Vegas shooting and the whole 9 yards, notice that the market's going higher. And that's because during an impulsive wave, it ignores the bad news. So it's very interesting how that happens. All right, now, for those of you that may have shown up late here today, I want to make sure that you download the cheat sheet. There's a lot of great information in that. The link is in the chat area of this box, of this admin console, so download that. And I think that will put you on your way to really getting more comfortable with the Elliott wave. And we've tried to make it a very simple cheat sheet so you can really have it on your desk. And when you start looking at markets, you'll have all the numbers there. All right, so let me open it up for a few questions here before you end. All right, and that would be great. Okay, Richard's asking, hey, how do you exit when you get into a target zone? Well, we have a very specific set of trading rules, Richard, to do that. And everybody, you know, we haven't really talked today about entries and exits, and we haven't talked about trading systems. We focus more on the Elliott wave counting itself. But I'm sure you have a particular method in which you enter and exit markets. And the idea is that when you enter a target zone, you never know if it's going to go to the upper part of the target zone or end in the lower part of the target zone. So my suggestion to you with that is that you use a combination of tools at your disposal. One is try not to get out of the market, even if it's in the target zone, all right, unless you have some form of an exit signal generated by your trading system. And we use the ART system, so it's very specific in generating these types of exit signals. But one of the ways in which we do things is when we're in a target zone, we try to move our stop up close, but not too close. And we do this through our what we call pyramid trading points. But then the idea is if we get a signal, like a pivot point signal in the opposite direction of the trend, if we're in the target zone, we will scale out of a third or even a half, but try to leave still a big position on so we're not getting out emotionally. I think that's the important part, because there's times when, if you get out at the beginning of a target zone, just for the sake of being in the target zone, you can leave quite a bit of money on the table. All right. Now, in our course, the Elliott Wave course that we have, we go into great detail on answering your question on how to get out of markets like that. But I'm sure everybody has a trading approach here. Great question. All right. Anything else? Any other questions? All right. Well, also too, you can also take a look at my book called The Elliott Wave Technique Simplified. It's on Amazon. You can check it out and order it there. There's a lot of information in that book that will also go into greater detail. And as I said, you can go to our website and check out some of the other information that we have there as well. All right. So listen, I want to thank everybody. That is the end of our presentation today. So hopefully we've been able to show how we can take the subjectivity out of the Elliott wave itself. And we do this again by combining both the classical and the modern approach to deliver high probability wave counts. And believe me, when you can do that, it's going to make target zone and entries and exits much, much easier, because you're going to have more confidence of where the market's going to go. So listen, I want to thank everybody so much for attending. Great group today. And also, if you want to contact us, here is our contact information.